Hello everyone, good morning and welcome to today's session. So today we will be continuing chapter 10 SRE 2400 and 2410. Remember in last lecture we discussed in detail what is the difference between the review and an audit with respect to a level of assurance and how it will impact the work or the engagement that you are going to perform. So I hope everyone is clear with that what we discussed in the last lecture about the SR, that is review engagements. Okay, a basic understanding of the review engagement and how they are different compared to an audit. Okay, so let's proceed forward. Now, when I talk about review engagement or limited assurance engagement, basically we need to take care of certain things that while performing these kind of engagements. And we saw when we were discussing about the topic, that what are the terms and conditions that should be there in order for an auditor to proceed with an engagement or practitioner to proceed with an engagement. Okay, so kind of a preconditions which are necessary, or certain scenarios wherein auditor or the practitioner, rather we will use the term practitioner over here over auditor, the practitioner should not accept the engagement, should not accept the engagement. Okay, we discussed conditions where practitioner should avoid accepting the engagement or should not accept the engagement. That is when the practitioner is not satisfied about the rationale or the purpose of the engagement. Number two, the practitioner is not satisfied with respect to appropriate circumstances of the review engagement. Okay, the practitioner has a reason to believe that relevant ethical requirement including independence will not be satisfied. The practitioner's preliminary understanding of the engagement is indicating that the review engagement or the information required for the review engagement will not be available, kind of placing a inherent limitation on the review engagement. Practitioner is has a cause to doubt on the management's integrity, and the practitioner is of the thought that management of those charges governance will impose a limitation on the scope of practitioner's work that will result either you know in disclaimer of opinion or adverse opinion, and that limitation will result in disclaimer of opinion or adverse opinion conclusion. So in those cases practitioners should not accept the engagement. If you reverse this, okay, if you reverse this, what will happen is you will get the conditions where the practitioner or the conditions which should be satisfied, before accepting an engagement. Number one, there should be rationale of the engagement, appropriate circumstances should be there. Okay, practitioner should be able to comply with the relevant ethical requirements including independence. Practitioner is you're sure that he will get all the information required and necessary for the review engagement. Practitioner has no doubt on the management's integrity. Practitioner has no doubt on management or those charged with governance will impose any limitation on scope. If these conditions are there, then practitioner should accept. Okay, same way, the way I'm saying that these conditions should be there, along with these conditions there are some other conditions that are required to be present, and that is that is your preconditions for accepting review engagement. The way we have an SA 210 preconditions before accepting a review engagements, same way we have a preconditions in SRE for the review engagements. similar to, I say 2010 preconditions. So kind of a reference for you guys to understand how and to what it is related to. Now, what are the preconditions, guys? When I mean precondition, what do you understand by preconditions? Can anyone explain me the term precondition over here? Can anyone explain me the term precondition? Come on, guys. Can anyone explain me the term preconditions? Anyone? What do you mean by preconditions? Viraj, Shailesh, Charu. Okay, good, Charu. Very good, Mancha. You can also Google it, guys. No issues. Just Google it preconditions. From there also you can get, understanding what is precondition. So when I talk about precondition, it means that the conditions that are required to be fulfilled before you accept an engagement or before you start the work. In this case, precondition for accepting the review engagement means these are the conditions that are required to be fulfilled necessarily before you start the engagement. Are you getting my point? So these conditions should be accepted. Now, let's understand in a practical way more, in a more practical way about the preconditions. Sorry for the throat. Good, Charu. Very good. Yes. Very good, Salish. Okay. Preconditions for accepting the review engagement. Okay. Now, when I talk about preconditions, like we understood what is a precondition. That is uh, that is necessary for the accepting the engagement. Now, let's say this is an engagement. I'm writing the engagement over here. Engagement is you have been appointed by management of ABC Limited. Okay, ABC Limited for performing review of for performing review of financial statement of FY 23-24, okay, that are prepared by management. This is required by DEF and DEF Limited, which is proposing to invest in ABC Limited. Okay, now simple, very simple engagement. You have been appointed by the management of ABC Limited for performing review of financial statement of FY 22-23-24 that are prepared by management. Now, this review is required by DEF Limited, which is proposing to invest in ABC Limited on the basis of the review report. Okay, on the basis of the review report. Now, considering this whole scenario, okay, what do you think what do you think, what could be the precondition to this audit? What do you think, what could be the preconditions to this audit? And logically, let's try to answer logically. Let me remove this one from here. Yeah. So what do you think that, what could be the preconditions of the audit, reviewing this review engagement? Now you are being appointed by management. Now, basically, based on the knowledge that you have received, with respect to the preconditions of the audit, what do you think the preconditions of review engagement, this review engagement could be? Some example. Keep yourself in the shoes of that person who is being appointed for ABC Limited. Now, before you accept a review engagement like this, what you will check? Come on, guys. What you will check? Okay, good Mancha. Let's make this more interactive. So that it will be very helpful for you guys also to understand and see the practical side of it. Okay, yes, Shruti, very good. Okay, Sailesh, very good. Come on, guys, quickly try to answer. Very good, Mancha. So one of the thing is that independence should not be compromised. Good. Second is availability of all the information. Another is that he should not be auditor of the company. Very good. Very good, Shruti. Another is financial statement should be as per applicable financial reporting framework. Very good, Mancha. What else? Very good, Shruti. That we need to agree with the management that we will be providing limited assurance. Yes. Come on, guys. What else? What would you include in your preconditions? What would you include in your preconditions? See, whatever items are included in preconditions will by default be part of your engagement letter. That is for sure. Because these are the preconditions which are required to be agreed before accepting the review engagement. And you get it accepted by management through engagement letter. You make sure that these conditions are accepted before start of the audit by management through review engagement letter. So these directly will become part of your engagement letter. Clear? Okay. So when I talk about preconditions, okay, when I talk about preconditions, the first precondition is, as you already know, the first one is determining whether the FRF, okay, which is applied in the preparation and presentation of financial statement is acceptable. Determining whether FRF is acceptable or not. So now another question I would like to ask with respect to the FRF. Okay, we saw one example. Let me open that example. We saw a review report. This one, this review report. What is the applicable FRF in this review report? What was the applicable FRF here? Remember, in last session, we saw an example of this review report, review engagement. What is the FRF here? If I have to ask you, the financial reporting framework, what is this financial reporting framework? Which one is this? If you have to name this financial reporting framework, like from where it is coming, from which law or regulation, from where this financial reporting framework is coming. It is in front of you from which law or from which act this financial reporting framework is coming. Come on, guys. Okay, Tanisha. Okay, Suraj. Come on, quickly. From where this, from which law, which regulation, this financial reporting framework is coming into picture? Okay, good Mancha. Yes. A bit of change, yes, but your answer is on the right track. Come on, guys. Which financial reporting framework is used over here? Pretty simple. Like from which law, which regulation I'm using this financial reporting framework? It should be easy for you guys. There's a direct answer to this. There is no, confusion or no complicated thing. Simple, straightforward answer. Come on, at least try. I'll suggest at least try. Shruti, Salish, Viraj, at least try it. Which financial reporting framework do you think is this one? And there is a purpose why I'm asking this question. Yes, Tanisha. Yes, correct. No, but that is in half answer. I would say there is one full answer. I'll explain you that. Okay, Salish. But from which law or regulation it is coming, or from where this financial reporting framework is coming? Uh, no, man, no, Mancha. No. Come on, guys. Hmm. Okay. For those who are saying this is, schedule three. For those who are saying this is schedule three, answer is no. This is not schedule three. Not schedule three. No. This is not schedule three. Schedule three never requires you to, prepare in this way. Schedule 3 don't requires you to prepare financial statement in this way. You have a division 1, division 2. This is not the appropriate way of division. If this is not the schedule 3, then how can you say this is acceptable? How can you say that this is acceptable? See, what we are trying to understand is to identify that how a financial reporting framework can be understood whether it is acceptable or not. Simple. I can, say that, okay, auditor practitioner needs to determine that, okay, whether financial reporting framework is acceptable or not. But how to identify that? It's a very big question. You need to understand practical side of it that, okay, this is how we identify whether financial reporting framework is acceptable or not. Okay. Again, my question is if this is not schedule 3, I'm saying this is not schedule 3 for sure. If this is not schedule 3, then how can I say that this financial reporting framework, in whatever way they have prepared the financial statement, okay, is acceptable? How? Let's say, Mancha, your answer that you're saying Ind AS. Okay. Now, if you are saying this is prepared on the basis of Ind AS, then who is saying me to follow Ind AS? Why I should follow Ind AS? Who is saying me that? Who is saying me that for entering results, I need to follow Ind AS? This is not Companies Act. No, not Schedule 3, not Companies Act. Or, then who is saying me to prepare this particular financial statement in this way? Who is? Anyone, guys? Anyone? No? No. Suraj, if you are saying this is special purpose framework, then from where it is coming? Who is, saying that this is special purpose framework? Think, because, I can just say, okay, this is auditor is required to do, this auditor is required to do. But how is very important. What you have understood, like what is the auditor is required to do. How he is required to do, again, very important. And okay, let me tell you the answer for that. So the answer comes from where, like, on the what basis you are preparing this particular financial statement. Like, who is asking you to prepare these financial statement? Is your, that particular authority will provide you like how to prepare it. And for that, we will go LODR regulations. I know, just for your understanding purpose, LODR regulations, okay, regulation number 33. I'll just quickly show you for your understanding. Now, this is a listed entity, and for the listed entity, why we are preparing this kind of, financial statement, and why the, auditor is reviewing this? The answer is LODR regulation number 33. Regulation number 33, what it says that the quarterly year to date results shall be prepared in accordance with the recognition measurement principle laid down in AS 25 or in AS 31. That is AS 25 and in AS 34 also. Okay. As applicable specified under section 133 of the Companies Act, read with the relevant rules framed thereunder as specified by the Institute of Chartered Accountants of India, whichever is applicable. Okay. The standalone financial results and the consolidated financial results shall be prepared as per the generally accepted accounting principles in India. Okay. Provided that in addition to the above, the listed entity may also submit financial result as per the IFRS notified by the Indian Accounting, International Accounting Standard Board. Also, if you see, the listed entity shall make the disclosure specified in Part A of Schedule 5. Also, there is, the format given. I'll show you here. So this is, all about the financial result. If you see, in addition to this, what all are things required to be, provided in the financial results, everything is listed in Regulation 33. If you see this one, the applicable format of the financial result, that is the statement on impact of audit qualifications and everything, shall be in the manner as specified by the board. So regulation 33 itself is providing that how you need to prepare the consolidated and standalone financial results. And if you see the report that was there, it was also saying this, that has been prepared. The statement has been prepared in accordance with the recognition and management principles laid down in India's 34 prescribed under this particular accounting, this section of Companies Act and other accounting principles generally accepted in India, and in compliance with the regulation 33 of the SEBI LODR regulations. So for me, the requirement is coming from section 33, regulation 33 is specifying how to prepare, what to prepare, and for me, that particular thing, for me, this whole regulation 33 is what financial reporting framework should be applied is there. Like, what financial reporting framework should be applied, okay, is like this one, this section, regulation. Yes, Mancha. So regulation 33 is applicable to the listed entities. And this is a listed one. Like the example which I'm showing you is the listed one. And if you see this one over here, okay, this is a listed one. This is a quarterly review. Remember in last example, last session, we discussed about the quarterly reviews. This quarterly reviews of listed entities. Same way, in our example that we were discussing, okay, sorry, over here. In our example, we were discussing, now we need to determine whether the financial reporting framework which is applied is acceptable or not. If we need to understand whether this is acceptable or not, we need to go back to the engagement, from where the engagement is coming. My engagement is coming from DEF Limited over here, which is proposing to invest in ABC Limited. So I need to check with the requirements that is being provided by the DEF Limited, like, okay, what is the acceptable financial reporting framework? And I am not the one who will prepare the financial statement. No, I am not the one. Okay, but I will obtain an agreement from management that they acknowledge understand their responsibilities. Okay, now responsibilities regarding for preparation and presentation of financial statement as per applicable FRF. They will understand, like, they have to acknowledge and understand their responsibility for internal controls. Okay, internal controls nearby the preparation and presentation of financial statement. So I will agree, I will take the acknowledgement from the management that, okay, you understand that it is your responsibility to prepare and present the financial statement as per applicable FRF. Now, applicable FRF will come from from where the engagement is coming. Why the engagement is there? The rationale behind the engagement. When we talk about the rationale, this is the rationale that, DEF Limited, which is proposing to invest in ABC Limited, require this, and that's why DEF Limited will provide you in which way they need the financial statement. So that will be agreed between ABC and DEF. ABC will prepare the financial, will give it to you. You need to check, okay, this is the agreement between DEF and ABC. And on the basis of that, you will perform a review. And why this is important is reason because, or understanding which FRF is applicable. Why this is important is because in a review you are already performing limited procedures, that is inquiry and analytical procedures. And over there also, if you don't understand which FRF is applicable, or if you go on this FRF part, if you go wrong on this FRF part, then you are done, because your inquiries will be wrong, your analytical procedures will be wrong, everything will be wrong. Are you getting my point? So that's why it's very important to understand which financial reporting framework is applicable. Then, preconditions for accepting the review engagement. Number one, acceptability of the financial reporting framework that we discussed. Number two, agreement of the management in acknowledging their understanding and responsibility for preparation and presentation of financial statement and internal controls, as I told you. Number three, providing access to all the information to the practitioner for the purpose of review. Reason because remember, in earlier also we were discussing when the practitioner should not accept. Over there also there was a point that if practitioner's preliminary understanding of the engagement indicates that the information needed to perform the review engagement, if it is not going to be available, then do not accept. So this directly becomes your precondition. This directly becomes your precondition. Then remember we discussed that there is a rational purpose for the engagement, okay, and that the review engagement would be appropriate in the circumstances. So this is something related to the FRF selection also. And this is a summary kind of for your precondition summary. And these are the detailed ones, same but in a detailed way. Okay, so determine whether financial reporting framework applied in the preparation of financial statement is acceptable. Okay, obtain the agreement from management that it acknowledges and understands its responsibility for preparation of financial statement in accordance with applicable financial reporting framework for such internal controls as management determines necessary to enable preparation and presentation of financial statement that are free from material misstatement, whether due to fraud or error, to provide practitioner with access to all information that is relevant. Okay, then additional information that practitioner may request, unrestricted access to the person within the entity. So these are the in a detailed way, but this is a summary. If you can, if you need a summary, then this is a summary of preconditions. And if practitioner determines that, okay, any of the precondition is not feasible or is not present, then discuss with the management of those charged with governance. Okay. If changes cannot be made to satisfy to the practitioner, okay, do not accept the engagement. Simple. Okay. Do not accept the engagement, or if you are bound by the law, then check what you can do in this scenario. Okay, so if practitioner is not satisfied as to any matters set above in the preconditions for accepting a review engagement, then he shall discuss the matter with management. Means if anything is not feasible from above, discuss the matter with management. If changes cannot be made to satisfy practitioner, then practitioner shall not accept the proposed engagement unless required by law or regulation to do so. So if any of the precondition is not present, then discuss first with the management. And if management still not changing, then do not accept unless required by law. And let's say if it is required by law, okay, if it is required by law, and you are somehow still have to give have to accept the engagement, then specifically mention that this engagement conducted under the circumstances which do not comply with the SRE, and accordingly no reference of SRE should be given into the your engagement letter. Same way, if the matter, if something has been discovered after you accept the engagement, okay, before acceptance the engagement, if you discover, discuss. If not discussed, withdraw. If not possible, then mention that it is not as per the SRE. But what if it is discovered after the accepting the engagement? In the same way, discuss the matter, whether the matter can be resolved, whether it is appropriate to communicate, continue the engagement, and how, if still practitioner has to continue the engagement, then how he can report the matter in his report. So these three things are required to be understood. So there are doubts. Unlisted entity can also publish voluntary financial results. If they want to publish, then what will they refer? Section 133 of as per the Companies Act. See, Section 133 only provides you the accepted, approved, AS and Ind AS accounting standards notified. So if you read the section 133, says that government to prescribe accounting standards, and under that section, government will prescribe certain accounting standards. So if any entity want to unlisted entity, okay, want to publish financial results, then the first question is rationale behind it. What is the rationale of publishing that? The circumstances why they are publishing it, and from there you can identify that what financial reporting framework should be used. Another question is, in the process of obtaining limited assurance, can the practitioner communicate with those charged with governance? Yes, they have to. They have to. So communication with those charged with governance is necessary. There is no option for it. Okay. Any doubt till now? Yes, preconditions will be same in the audit and in this reason because, see, before accepting any engagement, you have to get it agreed with the management that they have to provide all the information and their responsibility. That is for sure. Without which you cannot proceed for an engagement. And that will be, that's why I say, that's why I wrote similar to SA 210 preconditions at the start itself. Any doubt, guys? Any doubt? Okay. If no doubt, then another point that I want to discuss is agreeing to the terms and conditions. Okay. Now, preconditions by default will become part of your terms and conditions of engagement letter. Preconditions by default will become part of your terms and conditions. But there are some other terms and conditions also which are applicable over here. Okay, other than the preconditions. Other than the preconditions, there are certain other terms and conditions also that the practitioner has to agree with the management, and they need to understand, like practitioner needs to understand these terms and conditions in detail. Okay. So then what are these terms and conditions that practitioner needs to understand? Okay. So the practitioner has to agree with the management before starting the engagement. Okay. In a writing format, in a written format, or any other suitable format. Okay. Like an engagement letter or any other suitable written format, that number one, intended use, distribution of the financial statement, and any restriction on the distribution. So, what is the intended use of the financial statement? Like in our example, this one over here, we need to agree with the management about the distribution and use of FS prepared and reviewed. So we know that distribution and use is only for DEF. So we need to get it agreed. Okay. Number two, identification of the applicable financial reporting framework. We already see. Number three, objective and scope of the review engagement. Like, what is the objective and scope? That is similar. Over here. So rational purpose is nothing but objective and scope of engagement. Okay. When I say appropriate in the circumstances, that is something we need to understand whether the engagement is fit for what we are doing. Okay. Kind of, you can say, intended use and distribution. So for example, if this was supposed to be distributed on place of audited financial statement, then it is not appropriate in the circumstances. Okay. So kind of, you can say, distribution and intended use is something which is related to the appropriate in the circumstances. Then we have seen applicable financial reporting framework. Then responsibilities of the practitioner. As we have the responsibility of the management, we are also required responsibility plus responsibility of practitioner. So what will be the responsibility of practitioner? So we have a responsibility of management, responsibility of practitioner. Very important part that will be added in your engagement letter. Okay. That is, this is not an audit. A statement. This is not an audit. So kind of, you can say, I'll just provide it over here. Okay. So, kind of, a statement that engagement is not an audit, and this statement is very important. This is very important and required to be added in engagement letter plus your audit report, review report. I'll write it review report. That is a statement that the engagement is not an audit and the practitioner will not express an audit opinion on the financial statement. If I show you this statement in an example, see over here. If you see this one, a review from here. A review is information consists of making inquiry primarily of person responsible for financial and accounting matters and applying analytical and other review procedures. A review is substantially less in scope than an audit conducted in accordance with SA and consequently does not enable us to obtain assurance that we would become aware of all significant matters that might be identified in an audit. Accordingly, we do not express an audit opinion. This particular one is necessary, a statement that engagement is not an audit and practitioner is not issuing an audit opinion. That is very much necessary in all the review reports. All the review reports. Plus, this is required to be agreed in the engagement also. Terms of engagement. Then the last part that is, you need to get it agreed is the form and content of the report to be issued. Form and content of the report, reason because that will that is necessary because if there is any change in the form and content that you need to discuss with those type with governance, remember. So you need to get it agreed the form and content of the report also. Any doubt? uh, Mancha, yes, it is less compared to what it is. It is less. Okay. Any doubt, guys? Any doubt? Any doubt? No? Okay. If in case it's a recurring review engagement, can anyone give me an example of recurring review engagement? Recurring review engagement. Can anyone give me example of recurring review engagement? Anyone? Recurring review engagement. Anyone, any example of recurring review engagements? No? Yes? Okay, good Shruti. Yes, Tanisha. Yes. Okay, Mancha. Yes. Okay, I'll tell you. Recurring review engagements. Okay. Now, when I talk about recurring review engagements, basically it is nothing but, let's say, for example, if I give you simple example, okay, the simple example can be listed entities quarterly review. Listed entities quarterly review. Every quarter, a review is required to be done. That will be a recurring review engagement. Okay. So June quarter review, then September, then December, then March. Okay. So every quarter a review engagement is being performed. Now, if every quarter a review engagement is being performed, do you get a separate engagement letter for every quarter? Understand the question. Now, in a recurring review engagement, that every quarter a review engagement is performed, a review report is issued. Let's say, for example, if I have to give you a live example, just give me a minute. I'll give you. So if this one, let's say for example, is which quarter? Just a minute. This is April to this is September quarter for September quarter. Okay. Now let's go and see if just a minute. Then I have June quarter. Yes. Let me have this open also. Just okay. Now this is, if you see, this is for quarter ending June 30, 2023. Same review engagement. Okay. This is for quarter ending June. Now this is for quarter ending September. Quarter ending September. Now these are two review engagement. So I can say the September one is a recurring review engagement. So this is an example of a recurring review engagement. Now for these two review engagement, am I required a separate engagement letter? Again, am I required to get signed a separate engagement letter before each review engagement? What do you think? Do I require separate engagement letter? Yes, no. Do I require separate engagement letter? Anyone? Okay. Good Suraj. Good Yeduganalu. Good Shruti. Good Suraj. Yes. Absolutely correct, Mancha and Tanisha. So no, I do not get signed a separate engagement letter for each and every quarter. What I do is the engagement letter I get is signed for the whole year. Okay. The engagement letter which I get is signed for the whole year. I get it approved in that. So I get it approved in that engagement letter that about the whole what do you say, whole year. If I have an example, let me show you one example if possible. Let me check. Again, the example which I will be showing you is not an kind of standard template or some engagement letter example given in any of these standards. Just engagement letter I have with me for my understanding. Like we use the format, but it is modified appropriately to the circumstances. So I'll just show you an example of engagement letter, but that is again, as I'm saying, this is not a standard engagement letter. I'll repeat. Okay. This is for your purpose. This is to make you understand the example. Just a minute. Just let me share on that screen. Now, this particular, includes your review engagement, your statutory audit. And this is just to show you an example that how we, get it approved, all the engagements at one go. Okay. How we do in a documented way. So agreeing the terms, and we'll give you an example how we agree the terms. See, this is in format. I'm again, this is standard format. There is nothing, means you cannot, this is not a standard format, just for your reference purpose. Okay. If you see, what we do is when we decide the scope of work, okay, when we go for the scope of work, we get it agreed about the statutory audit to conduct this statutory audit, and we go for limited reviews to conduct the review of unaudited financial results for the quarter ending and period and everything in a single go, in a single particular what do you say, engagement letter. That also covers audit of consolidated affairs, tax audit if applicable, statutory audit. So one standard engagement letter we get it signed, which has all the things like auditor's responsibility. Okay, then you have a management responsibility in detail, like the things which we are seeing, the preconditions, everything is in detail over here. Okay, like to provide all the access, additional information, whatever we are actually learning, that becomes part of your engagement letter. You have this example in front of you. Okay. So everything is covered in this particular, we try to cover everything in a single engagement letter. Matters to be communicated with those charged with governance, a lot of things. So I'll show you one limitation on, use and everything. We have a list, we have about independence. We have about end use, like, for which purpose this will be used. Okay, who will be provided this particular information, everything about, so a lot of things are there in a particular standard engagement letter, and this is we use. Now when a recurring engagement comes, okay, where we kind of, basically get it agreed once. Okay. Now, for each and every quarter, we only look for if there is any change in the terms and conditions. Terms and conditions have been already agreed in your single engagement letter. Okay. When you got your engagement letter signed, terms and conditions got agreed. But what if, whether those terms and conditions are still the same quarter on quarter, that you need to evaluate. Okay. So the practitioner is required to evaluate whether circumstances, including change in engagement acceptance consideration, okay, require any revision, require any revision. And if yes, then whether any, the revision is appropriate or not. So for recurring engagement, practitioner needs to review the terms and conditions. Okay. Needs to review terms and conditions from time and time in order to understand whether these require any changes or not. And let's say, for example, if there is a change in the terms and conditions, whether a recurring review engagement or it's a normal one-time engagement, okay, you are being performed, but after start of engagement, there's a change in terms and conditions. Okay, then practitioner shall not agree to the change in terms and conditions if there is no reasonable justification to do so. There should be some reasonable justification for accepting the terms and conditions, for change in the acceptance of terms and conditions. Okay. Without that, no change should be accepted. Without reasonable justification, no change should be accepted. Clear? So this is how you need to agree with the terms and conditions. Number one, what terms and conditions should be part of your engagement letter? Number two, for a recurring engagements, check from engagement to engagement whether there is any change required where you have only one engagement letter applicable for multiple engagements. Any doubt, guys? Any doubt with this? Any doubt? Any doubt? See, I'm showing you practically the examples, engagement letter, the limited review reports, and everything for your understanding. Okay. So if you have any doubts with respect to any of the part, I'll request ask freely so that you can get more knowledge and understanding of this. See, this is for the first time that you are, looking for this particular type of what is it? Uh, review engagement standard, and that's why it may happen that might be confusing a bit initially, but I'm trying to make it more practical as it's possible. Okay, if no doubt, let me proceed further then. Now, this is all till the time of acceptance of the review engagement. Now, once you accept the review engagement, then what? Then how to perform is another stage. So first was acceptance. Now comes the performance. But before performing the review engagement, you need to perform risk assessment and determine the materiality. The way we do in SA 320, if I have to provide a reference, like SA 320, we determine the materiality. Same way for the review engagement also we need to determine the materiality. Okay. Now, you must be wondering why materiality is coming into the picture. Reason because at the end we are still issuing an opinion. It's a limited assurance, but yes, there is some kind of assurance. And wherever there is some kind of assurance, there is materiality. Okay. If you have assurance, you have a materiality for sure. So what SRE says with respect to the materiality is that practitioner shall determine the materiality for the financial statement as a whole and apply this materiality to determine the design the procedures that are required to be performed. Okay, to obtain the assurance or to obtain the evidence to provide the limited assurance. Now the question comes is how to apply the materiality here. How will you apply? Like, okay, for example, I have this, limited review results with me. Okay, the management prepared this result with me. Management prepared the financial statement and gave it to me. Now I want to, perform a review. How will I determine the materiality? How will I determine the materiality for this particular financial statement? How will I determine the materiality? Okay, SRE saying, please determine the materiality, but how? That is a very important question. How to determine the materiality? Anyone can give me some example. How will you determine the materiality over here? On what basis? How will you determine materiality for these kind of engagements? Come on. Materiality is important in audit. Yes, Suraj. But wherever you have to provide an assurance, you have to use materiality. So whenever there is an assurance engagement, there is materiality in picture for sure. But the question comes is in review, how will you determine the materiality? On the basis of our objective. Can you give some example, Mancha, of that? Can you give some example? So one answer is taking the amount of profit or expense of high and material nature based on the nature and operation of the entity and size of financial information. Now the question comes is if I do this way, taking amount and profit or expense, that is the same I do in audit. Then how it is different from audit? If the way I'm calculating the materiality in audit, let's say for example, let's say most of people what they do is in audit they will take profit for the period, this one, and they will multiply with a particular percentage. Let's say materiality, sometimes they take it 10% of profit before tax. Okay, let's say it comes to 518, whatever rounding of it is happening, it's CR or lakhs or whatever it is. Okay, so let's say this is they do in audit. Okay, let's assume let's this they do in audit. This is in CRs or what? Yeah, in CRs. So this will be CR. Okay. Now this I do in audit, this particular calculation. Let's say I do in audit. How will I do in review? What I will change here? Okay, ये दो को डालूं. Good. Benchmark. Agreed. Let's say, for example, here you are taking in audit, you are taking a profit benchmark. What you will, which benchmark you will take in review? Revenue or gross profit ratio? I think if you will take the revenue again, it will go same on the line of audit. Come on, guys. How will you determine the materiality? What different you will do over here? Because this is not an audit. So the audit materiality, audit thing I cannot do over here. How differently I will determine the materiality in review? Comparing with the past financial statement. But again, let's say for example, Suraj, if I compare with the past financial statement, let's say I have the comparisons over here. If you see 23 and 22, both are there here. Comparison is there. Again, like if I have to determine the materiality over here, let's say last time it was 514905, this time 5189. How will I determine materiality by comparing these both? So if I compare these previous year quarter figures, then how will I determine the materiality? What should I do after comparison? Even if I compare with the previous quarter, this is the previous quarter results for me. Okay, June quarter over here, results are there for me. Even if I compare with the previous quarters, how will I determine the materiality? And even, let's say, for example, when I perform a limited review, I do unaudited quarterly results for the quarter ending. Okay, 30th September. So this is quarter related. This is quarter, means 3 months. This is unaudited results for 6 months. So this is 6 months. And audited results for the year ended. This is a comparison. Okay. These two are comparison, but this is for 6 months over here. If this is for 6 months, and here on the other side, on one side, I am only referring to 3 months, then how will I determine? Do I need to determine two different materialities, one for the 3 months, one for the 6 months? Do I need to determine two separate materialities, one for 3 months and one for 6 months? Answer is no. So ratio analysis, benchmark approach will not work over here when I talk about materiality. In a review engagement, materiality will not work in this way. Trust me. Then how the materiality will work? What should be done to determine the materiality in that case? What should be the appropriate way to determine the materiality? Okay. Now, if if a materiality is required to be determined, okay, in a review engagement, that is required to be determined on the basis of judgment rather than benchmark. We need to follow a judgment approach. I'll tell you and explain you how. Materiality through judgment approach. What is judgment approach in calculating the materiality? See, this problem comes when your applicable financial reporting framework doesn't provide you a threshold of materiality. Okay. If, let's say, for example, in our example, this one, if DEF Limited gives you that, okay, for them, what is material, then you have a materiality. Problem solved. Everything is solved. Okay. Now, this problem arises when there is no threshold or no this, any benchmark or anything has been provided by your applicable financial reporting framework. If nothing has been provided by your applicable financial reporting framework, in that case, you need to apply the judgment approach. What is the judgment approach of materiality? It's pretty simple. Judgment approach is simple that if if a particular misstatement, if a particular misstatement okay, if a particular misstatement is going to influence, if the particular misstatement is going to influence the decision of user or reader, then that is material. In other words, okay, you need to understand why this particular financial statement are prepared. Why this particular financial statements are prepared. For example, this one. This particular financial statement is prepared for compliance with Regulation 33. Now, if you go to Regulation number 33, okay, financial results. Over here, okay, over here, if you will identify why these, this is prepared. This is basically prepared. Okay, the reason behind of preparing the financial statement for the review purpose. So this is submitted to the stock exchange, and stock exchange then publishes this in the market. Now, as I said, this is a very limited assurance engagement. Okay, when this is a limited assurance engagement, you are providing very limited assurance. You are doing an only inquiry and analytical procedures. So for sure, your procedures will be, will have a less tendency to identify a misstatement. But let's say, for example, you have identified a misstatement. Now, again, you need to understand what is misstatement. Let's say I performed an inquiry. And came to know that this particular number of sale of product contains misstatement. This particular number of or sale of product contains misstatement. Now the question comes is how much? Because you have only performed inquiry. So by inquiry, on what level you can provide, that kind of, identification that what is the amount involved, which is very difficult. Unless and until you don't perform the procedures, audit procedures, you won't be able to identify the amount. And that's why this comes at judgment level. Because I need to understand on the basis of my preliminary investigation, inquiry, analytical procedures, what is the amount I expected amount. Because everything will be here working in a level of expected. You won't be performing audit procedures. So you might not have the exact details. So everything will be working on the basis of expected. So what is the expected amount that you think is involved in this scenario about the misstatement? And on the basis of this expected amount, You can then decide whether it's a material will influence the judgment, because at the end I am writing this is unaudited. Simple. This is unaudited. It's not audited. Okay. It's unaudited. And another thing is, if you see, if you see over here, again, my opinion, my opinion is that anything, like, whether anything has come to my attention that causes me to believe that the financial statement are not prepared in accordance with FRF, are not prepared in accordance with FRF. I'm not talking about free from misstatement. No, I'm not talking about free from misstatement. Here the words free from misstatement, whether due to fraud or error, are not there. My objective is not to comment whether the financial statement are free from misstatement, whether due to fraud or error. No, I am only required to perform review that whether the financial reporting framework, in this case, regulation 33, has been complied with or not. So majorly my portion or my, in review engagement, it goes with only the disclosure part. Okay. Rather than on the numbers, I focus on the disclosure more, because that is the opinion I'm giving over here. Whether in all material respect, in accordance with the applicable financial reporting framework, it is prepared or not. Simple. The financial statements are as per the applicable FRF or not. So that's why I need to use a judgment approach when I am deciding the materiality. And accordingly, I need to determine what is material from the judgment point of view rather than from the number point of view. Are you getting my point? So again, here materiality is determined based on the practitioner's judgment. That's it. Rather than the number. The practitioner judgment is about the material in relation to the financial statement as a whole. So on the basis of that, you need to, decide your materiality. Am I clear with respect to the materiality? Understand what is the opinion you are providing. If I again show you the wordings of the opinion here, based on our review as conducted above, nothing has come to our attention that causes us to believe that the accompanying statement, again, I will highlight for you, accompanying statement prepared in accordance with the recognition and measurement principle laid down in the Indian accounting standard and other accounting principles generally accepted in India, has not disclosed information required in terms of, this is very important, has not disclosed information required in terms of regulation 33 of listing regulations. I am talking about disclosure requirements majorly, that nothing has come to my attention. Does this particular financial statement prepared in accordance with Ind AS, that is, we have already discussed, Ind AS 34 and other generally accepted accounting principles, has not disclosed. I'm talking about more on the disclosure part rather than, on the amount side. Okay. So again, by performing the limited review procedures, okay, of inquiry and analytical procedures, you need to check whether anything has came to your attention that could be material. Am I clear? Any doubt? Any doubt, guys? Till now? Any doubt, guys? No? So there is a so basically, if you see, I think there is one there is a circular also. Okay, with respect to format, and the financial statement format is there for the limited review. That is a circular of 29th July 2022. Okay, 29th July. So not the 29th March 2019. No, not that one circular. Circular is 29th July 2022, which is basically on the format of the limited review given by the SEBI with respect to this one. Regulation 33. So you can refer that one also, for the format. Like what are the disclosure requirements basically? Okay. So if no further doubts, okay, if no further doubts, then I propose to, take a break of 10 minutes and then we'll gather back and we'll continue the session. Will that be fine? Let's take a quick 10-minute break then. Hello everyone, welcome back. Let's continue the session. Okay, so we were discussing about you know materiality concept. Now, once you decide the materiality, on the basis of that, we need to perform the procedures. Okay. Now, when I talk about we need to perform the procedure performance can include like understanding the entity, then understanding about the business, about the financial reporting framework. A lot of things can be there. Okay. So once you decide the materiality, the practitioner is required to obtain the understanding of the entity and its environment. Okay. Now which will include like relevant industry from which the basically the entity is, the financial reporting framework, the nature of the entity, operations and everything. Okay. Entities accounting system, entities selection of accounting policies and procedures. A lot of things are required to be understood. Okay. Before you proceed, reason because if I have to tell you like okay, there are things which are require some additional disclosure. Now let's say for example, okay, let's say for example, this LODR limited review. Okay, we'll take up this example only, LODR limited review. Okay. Now if I talk about this LODR limited review, then what I am required to disclose is it's something that I need to understand first. Okay. And in order to disclose that, for example, I'll show you one master circular. So, not this one, sorry. Let me show you one master circular. Now, this is the master circular that I was talking about. Okay. This provides that how a review is required to be done, what are the things which are required to be disclosed in a review. Okay. So this is something with respect to the regulations which are there and the quarterly review that is required to be done. Okay. And this is to all stock exchange, like applicable to all listed entities. Now, if I talk about, let me go to the financial disclosure 14 to 17. Yeah, over here. Financial disclosure, which is required under Regulation 33 of LODA that we have seen as an example. Now, what is required to be disclosed is given under this format that I was talking about. What is required to be disclosed? Like, the way it is required to be disclosed, and quarterly annual segment information, which is segment revenue, segment results, segment assets, segment liability. Now, you can disclose this once you have the understanding of the entity. Let's say, for example, segment related. Now, segment related, you can only disclose once you have the understanding of the entity. Otherwise, how will you get the, a segment bifurcation? Okay. Then disclosures for the reason for delay, that's another story. Then there are some additional disclosures which are required. Okay. For example, so there is a format given for the listed entities for bank and insurance companies in C1. If you see C1, format of this is the format of report that is given. Okay. Just let me go back to the top. Show you. Let me show you something more. Yeah. So based on this format, disclosure format is there. There's a disclosure impact of audit qualification. There are a lot many things for the disclosure part. Related party disclosures, related party transaction disclosure in a particular format. So you can only disclose these things once you have the understanding of the entity. Otherwise, how will you disclose, okay, what is the related party? Whether the all the related party transactions are disclosed or not. Okay. There's a lot RPT disclosure. Okay. RPT approval disclosure. You can only, provide this disclosure once you have the understanding of the entity. Now that is applicable in the limited review, quarterly limited review. But let's say, for example, it's an annual limited review or limited review based on some other engagement. Okay, based on some other requirement. In that case, you need to understand what is the entity and its environment in order to provide the appropriate, whether the, disclosures are appropriate or not. Then you are required to, design and perform procedures. Now, as I say, the procedures are inquiry and analytical procedures that we perform. Okay. The procedures that are performed are inquiry and analytical procedures. Now, the question comes is that inquiry and analytical procedures, how, how should I determine which inquiry and which analytical procedure I need to perform? So, to address all material items in the financial statement, including disclosures, to focus on addressing areas in the financial statement where material misstatements are likely to arise. These are the two areas which I am required to focus upon. Okay, which I am required to focus upon with respect to my procedures. That is one, all material items in the financial statement. Materiality again will come from my judgment. Okay, judgment based materiality and all the disclosures. Second, to focus on addressing areas in the financial statement where misstatements are likely to arise. If you have a past record, past, audit reports, past history of the entity, okay, and you have some information on that, like what was the outcome of previous limited reviews, where were the misstatement identified or something like that, very high risky areas where there are high chances of misstatement, then that particular area. So your procedures will be designed to tackle these areas. Okay. So your procedures will be designed to tackle these two main important areas in a review. I am not going to the audit based on the materiality, to gain the comfort and identify whether all the, material misstatement are identified. No. Whether to address all material items, okay, including disclosures, and to focus on the financial statement where material misstatement are likely to arise, and that to inquiry and analytical procedure. That's it. Okay. Now, again, as I said, this is circumstances and case to case basis that, the procedures that you will perform, either you will perform inquiry, either you will perform analytical procedure. Okay. But you will perform this procedure in order to achieve the objective of the SRE, that is to issue an opinion, limited assurance opinion. Okay. Now, let's say, for example, you have identified any significant or unusual transaction. Okay. Then you might focus more on that significant and unusual transaction. That again totally depends upon the type of transaction. Okay. Now, let's say, for example, inquiry. So what you will do in inquiry? Like, as I'm saying that, we will do inquiry and analytical procedures, then what we will do in inquiry? Okay. In inquiry, as you are already aware that we will seek information from management. Okay. From management and other persons within the entity. Now, what information we will seek? That how they have disclosed the amount, from where they have disclosed the amount. Okay. Let's say, for example, if there are some estimate, then how they have made the estimate. If some numbers are there, then from where they have taken the numbers. Okay. So we will include inquiries, we will make inquiries with respect to the relevant material amounts and relevant material disclosures. Okay. We'll make inquiries related to the accounting estimates, identification of related parties, significant and complex unusual transactions. Okay. Any suspected fraud, events occurring between the date of financial statement and practitioner report. Basis for the management assessment of going concern. Okay. Or any event that may cast significant doubt on the entity's ability to continue the going concern. Material commitment, contractual obligations. Okay. We'll perform inquiry for these areas. Again, inquiry for these areas. Now, this is not limited to, but some examples of areas where we will perform inquiry. Okay, some areas where we will perform the inquiry. We may include non-monetary transactions in our inquiry. Okay, material non-monetary transactions or transactions for no consideration in the financial reporting. We may include. Okay, but that again depends upon the type of financial reporting framework. Depending on the circumstances, as I told you in inquiry, okay, depending upon the information that you received in the inquiry, uh, you may communicate uh, things with the management. You may ask management if they have received any communication from the regulatory entities, any action taken by the committees, or because I'm talking about from the listed entity point of view, so you have multiple committees. So any action taken by the committees, those charged with governance in some meetings, minutes of meetings, you will say. So you will identify those things and in your inquiry. So also, you need to understand, okay, what was the management's intent behind providing you the information. So let's say I'm doing the inquiry, but whether management is providing me the correct information or not, I need to understand by applying professional skepticism. So I need to corroborate, the evidence that I've received by inquiry and with the other evidence or understanding that I have in my hand. So, if I have identified inconsistencies, then the practitioner needs to consider reasonableness and consistency of the management response in light of the results and obtained of other procedures. Okay, let's say, for example, I performed the inquiry about related party transaction, but management told me there is no related party transaction. However, I can see some related party transactions already in the last year's audit report, because I'm the practitioner, I'm not the auditor. Okay, so I could see some related party transaction in last year's audit report. In that case, there is an inconsistency. Then I need to understand the reason for the inconsistency. I need to identify whether can I rely upon the management's response that has been provided to me based on the understanding I have gathered. Yes, Manjab, absolutely correct. So inquiries on the areas where practitioner thinks that is material for the understanding and the stakeholders, for the readers. I may perform inquiry about the going concern. So again, I will perform the inquiry a lot of places. Then I may perform the analytical procedures. Okay. Now to perform the analytical procedures, again, as you already know, I need to perform, okay, analytical procedures focusing on the data that I have received from the accounting systems, or from the management, whether it may be information produced by the entity IPE. So I need to understand from where I received the data, and accordingly I need to perform the analytical procedures based on the available data. Based on the available data. For example, I may perform analytical procedures like trend analysis, variances, quarterly comparisons, the ratio analysis. A lot of things can be performed. Okay, and then the analytical procedure evidence and the inquiry procedure evidence together will help me to understand whether anything came to my knowledge that will that if led me to believe that the disclosures are not appropriate. Now, again, as I told you, various methods are there for the analytical procedures. Various methods are there. Sorry. Sorry. Sorry for the bad throat. Okay. Now, very important thing, why we are only restricted to analytical procedures and inquiry. Okay. Why we are only restricted to inquiry and analytical procedures. Okay. See, now, when we are performing inquiry, okay, when we are performing inquiry, we are actually, taking the evidence, we are understanding the entity, we are understanding what management has to say about the preparation and presentation of the financial statement. And to corroborate that inquiry, we perform analytical procedures. Okay. So first we perform inquiry, take that as a primary source of evidence, and then to support the inquiry, because we know inquiry alone is not sufficient. That's why we add analytical procedures over the inquiry to support the inquiry, kind of, you can say. Because alone we cannot trust on the inquiry, okay, the information provided by the management. That's why we have to carry some analytical procedures to support the inquiry. Okay. For example, let's say management is saying to you that the numbers, the revenue numbers have increased compared to last year. Fine. Because there was a good amount of, product mix that was selected, or some kind of, price decrease was there, something of that sort. But the sales has increased. Okay. Now you have got that information. Okay. The management decreased the price, and that's why there is an increase in sale. You can corroborate that information with the analytical procedures, and then you can conclude, okay, whatever inquiry that has been done or the results of inquiry are reliable. Okay, are reliable, and accordingly you can consider, okay, this is now whatever I have received now is a reliable inquiry. Okay, I can rely upon. That's why inquiry plus analytical procedures are very helpful in review. Okay. So analytical procedures will help update the information that has been received in the inquiry. Now, there are some specific procedures that we need to perform, and that will depend upon case to case basis. It may depend upon the financial reporting framework. Okay. For example, one is a related party. Just now I show you there is a additional reporting requirement with respect to the related party for quarterly limited reviews. Same way, this kind of like these are the additional areas where you know auditor has to pay some more focus, some more attention with respect to limited review. You can say kind of special areas, specific areas also. Okay, so specific areas. First, as I told you, related parties. So during the review, now practitioner has to remain alert for the arrangement and information that may give existence or indication of the related party transaction. And if any significant related party transaction outside the normal course of business has been identified, then practitioner shall inquire at the management about the nature and the transaction, possible involvement of the related party, and the business rationale of those transactions. Okay. So these are additionally that we need to perform over inquiry of the normal areas. Okay. Then non-compliance with laws and regulations. Fraud and non-compliance with laws and regulations. So practitioner has to perform inquiry, with the management or senior level, with those charged with governance, whether they have identified any fraud or non-compliance with laws and regulations. Okay. And how management has made sure that they have identified all the non-compliance with laws and regulations. So auditor has to perform that level of inquiry, and that level has to gather that level of understanding with respect to fraud and non-compliance with laws and regulations. So it could be kind of suspected fraud or non-compliance with laws and regulations. Okay. And if auditor identifies or practitioner identifies that there is a suspected fraud or non-compliance with laws and regulations, okay, when practitioner identifies, in that case, practitioner shall communicate with the appropriate level of senior management or those charged with governance about that suspected fraud or non-compliance. And accordingly, he needs to conclude whether it has an impact on the reporting or not. Next part is a going concern. Okay. Now, again, practitioner has to, in a review of a financial statement, include consideration of the entity's ability to continue as a going concern. So, practitioner has to, validate management assessment of the entity's ability to continue as a going concern. Okay. So he needs to take the period he needs to look after the period that has been taken by the management. He needs to perform the inquiry about the management's future plan. Okay. Of entity's ability to continue as a going concern. The way we do, in SA 570, similar fashion, we have to do it here also. So these are the, areas which we have already seen while, discussing the essay. Okay. Let's say, for example, and when I talk about the going concern, sorry, I talk about SA 570. When I talk about, fraud and non-compliances, I talk about SA 240 plus SA 250. When I talk about related parties, I talk about SA, sorry for the bad throat. Okay, SA 550. Okay. SA 550, again, that talks about related party. So if you go to those essays, you will find, okay, what, inquiry procedures auditor is required to perform. Same inquiry procedures, are carry forwarded over here. Like evaluate the results of those inquiries with respect to the going concern. Okay. Whether going concern basis is appropriate or not. Then using the work performed by others. Okay. When I talk about using the work performed by others, over here it is, other practitioners. If there is any other practitioner who has already performed some review, okay, who has already performed some review other than the field of accounting and assurance with respect to some area, okay, then I can use their work, like of, using the work of expert. So I may involve other practitioners, okay, other than the field of assurance and accounting, and I can rely upon their work based on, like, based on the appropriate inquiry I need to perform for that. Again, you can, in a similar fashion, I can, I just need to make sure that, the work that is performed by the other practitioner is adequate for my purpose. And I need to take appropriate steps to satisfy myself that, okay, the work that has been performed by other practitioner is appropriate. Okay. On the similar lines, the way you see in, SA 620. Now, additional procedures when you identify a misstatement. Okay. Additional procedures when you identify or aware that, financial statement are materially misstatement. Okay. If you identify any misstatement or if you become aware that the financial statement may be material misstatement, why I'm using the term maybe? Reason because, here I'm talking about that I am performing the inquiry and analytical procedures. So I may not have all the evidence in my hand. That's why I'm saying may be materially misstated. Okay. So that's why I will use the term may be over here. Because I'm only performing review, not the audit. Once I identify, let's say, if I have a doubt that, they may be materially misstated, then in that case, I need to conclude, okay, whether the matter is not likely to cause the financial statement as a whole to be materially misstated, means whether that the expected misstatement is going to impact the whole financial statement, whether that expected misstatement is likely to cause whole FS to be materially misstated. Number two, I need to determine the matter that is causing the material misstatement. Determine the matter in detail. Reason because till now I have suspected that there could be a misstatement. Okay, maybe suspicion, suspicion that there could be a misstatement. Then if I, identify, I have a suspicion, then I need to first of all make sure whether the expected misstatement is likely to cause the whole financial statement to be misstated. Then number two, determine the matter that is, impacting or, creating the misstatement in detail. And for that, I need to design and perform procedures, additional procedures, okay, to gather the sufficient and appropriate audit evidence. I may perform additional inquiry, or I may perform substantive test of detail or external confirmations if I, identify such kind of scenarios. Clear? Any doubt till now? Okay, so there is one doubt. Uh, Expert committee, SC expert committee. I'm not sure about that particular one mentioned. Supreme Court expert committee, I'm not sure. Sorry. Here, practitioner is a chartered accountant in public practice. That's the practitioner term we are using over here. Yes, all the procedures are same that we do in audit, but here the procedures are restricted to the inquiry and analytical procedures. Areas are same. You can say area is same. Subsequent event, related parties, accounting estimate, going concern. We will see, more areas, but everything is same but restricted to the inquiry and analytical procedures. Can auditor of the company refer to the limited assurance report while conducting the audit? Answer is no. Answer is no. While performing the audit, okay, can you refer to the limited assurance report? That depends upon where you are referring and why you are. So, in order to rely upon the work performed by practitioner during the limited review, okay, that totally depends upon you need to comply with SA 600 and 620. Okay, so let's say for example, if while at the time of consolidation, there are some financial statement where I have limited review performed but not the audit. At that point in time, I can just mention in my report that okay, for these particular subsidiaries, limited review financial statement were available to me, not the audited ones, and accordingly I have relied upon the same. So over there, yes, it is possible, but for other areas, I don't think so. The reliance can be placed because in limited review, level of assurance is very less compared to the level of assurance you receive in the audit. Any doubt, guys? Any doubt? Any doubt till now? No? No doubt? Okay. If no further doubts, then let's proceed further. So, next point that I want to discuss is about events occurring between the date of financial statement and the date of practitioner's report. Okay, that's the subsequent events we talk about. Okay, now way we have our SA 560, same way we are also required to give impact of the subsequent event. Now, what SRE says then, if any practitioner becomes aware of the events occurring between the date of financial statement and the date of practitioner reports that requires adjustment or disclosure, okay, then request management to make such disclosures and correction. So, adjusting event, then request the management to make such disclosures. Okay. However, practitioner has no obligation to perform any procedure after the date of practitioner's report. After the date of practitioner report, no procedure is required to be performed. But from events occurring between the date of financial statement and practitioner's report that requires adjustment, then practitioner shall request management to make those adjustments. Now, same way, on the similar line, if practitioner comes to know about any event, okay, after the date of practitioner's report, that would have caused practitioner to amend his report. Okay. So any event after the date of practitioner's report. Okay. But before the date of issue of financial statement. Okay. Any event or fact known to the practitioner that may have caused the practitioner to amend the report. In that case, what you will do? Number one, discuss the matter with the management of those charged with governance. Okay. Determine whether financial statements are required to be amended. And how management is, intending to address the matter. If management does not amend the financial statement when it is required, okay, then practitioner shall notify the management, please not issue the financial statement to third parties. And if financial statements are still issued without necessary amendment, then practitioner shall take appropriate action. Same on the similar lines that we have seen in XA 560. Just the difference is, instead of audit report, we have practitioner's report. Now here, when I talk about using the work of other practitioners, okay, work performed by others. Here, if you see the terms and in the wordings which are used even in the SRE, okay, is that work performed by other practitioners or the work of an individual or organization possessing expertise in the field other than assurance and accounting. It can be any other practitioner. So not necessarily a CA, but let's say, for example, some engineer is there, architecture is there, architecture is there. Then, if he has performed some review and if that work is relevant for my purpose, then I can, take reliance upon the work. So no need to be a CA only. Any doubts? Any doubts? Okay. So if no doubts, then just a minute. Let me take just a minute. Okay, yeah. Now, the next part that I want to discuss is about written representations. Again, application of another essay in line with for review. So we already have written representation essay, that is essay 580. So you can draw a reference from there. On the similar lines, we have the requirement here of written representation. That is, we need to make sure we request management to provide a written representation that they have fulfilled their responsibility described in the engagement letter. Okay. A written representation is required rather than the oral. Okay. That management has fulfilled its responsibility for the preparation and presentation of financial statement, and all records reflected, all transactions has been recorded in the financial statement. Uh, have been, all transactions have been reflected in the financial statement. So we are required to take this representation from the management. Plus, I also may take representation with respect to the related parties, significant facts or frauds, okay, known or actual possible suspected possible non-compliances, information about with respect to the going concern, events occurring after the practitioner's report or financial statement date, material commitments, non-monetary material transactions. So I may take the written representation on all these matters. So the matters we have discussed earlier, I can take a written representation on all these. Okay. Then what if the management doesn't provide you written representation? Okay. What if the management doesn't provide you written representation? In that case, what you need to do is discuss the matter with the management or those charged with governance. Now, if management is not providing written representation, then evaluate the effect of not providing representations on your opinion with respect to evaluate the integrity of the management also, and take appropriate actions by determining the possible effect on the conclusion. Sorry. Okay. So by this way, you can either take the written representations from the management, and if management doesn't provide you written representations, you need to perform these steps. These three steps, very important. This is the same way that we have seen in essay. On a similar line, there is nothing new that we are learning over here. Trust me, just essays being modified and applied to the review. Essay being modified and applied to a review engagement. That's it. Concept and the logic is same that we have already discussed. Concept and logic is already same. Now, remember we talked about the integrity of the management. This is part of the preconditions already. Okay, this is part of preconditions. If there is lack of integrity, okay, if management does not provide you required representations and information, withdraw from the engagement. If possible, then withdraw. Mhm. Now, evaluating the evidence obtained from the procedures performed. Okay, again, we have a similar essay on this line. That is, if I talk about that is, essay 450, evaluating of misstatement and identified during the audit, or kind of, evaluating the evidences. So somewhat similar to essay 450. So auditor, practitioner needs to evaluate whether sufficient and appropriate audit evidence has been obtained by performing the procedures. If not, then perform additional procedures. Then practitioner needs to perform procedures judged by the practitioner necessary. So kind of additional procedures. Okay. Now there could be some scenarios where you cannot gather evidence. Okay, by only inquiry and analytical procedures. Okay, there could be some specific conditions or uh, scenarios where you have not obtained evidence that is required through primarily inquiry or analytical procedures. If your evidence that you are obtained, okay, from the procedures is not sufficient, then either extend the work you have performed or perform other procedures which may include substantive procedure, but that again depends from case to case basis. But again that depends case to case basis, that you have to see from case to case basis. Okay, and if you are not able to obtain sufficient and appropriate audit evidence, okay, to form a conclusion, then determine the effect on the report. Okay, whether you can give a conclusion based on the evidence you have obtained. If not, then what is the impact on the conclusion? Do I need to issue a qualified opinion or disclaimer of opinion? Okay, and communicate with those that with governance and management. Okay, as appropriate, that because of this particular thing, I'm not able to obtain sufficient appropriate audit evidence, and that may impose or have such, that may be a limitation on the scope of review. Okay. So you need to accordingly evaluate what evidence you have obtained and what evidence was required. Clear? Any doubt till now? What we are doing is similarly on the line of essay, we are just reviewing whatever we have done in the essay. That is the same concept is being applied to your review. One by one, each and every step, the way you do in the audit, the similar fashion we are doing in the review, but in a limited form. But in a limited form. Any doubt, guys? Any doubt? No, Manisha. So in exam, when the question will be there, so there is an answer, predefined answer behind that. On the basis of that, those questions are, the answer you give are checked. So there is no judgment based checking. There's a specific definite, guidelines are there for the checking the answer, and on the basis of that, the answers are checked. Any other doubt, guys? Any doubt? Any doubt till now? Any doubt? Okay. If no doubts, I have one question to ask. Pretty, question you can say mixing, related to two different topics together. Let's say. So, let's say Mr. Manan, while performing review of, okay, ABC Limited's quarterly FS, okay, as per SRE 2400, okay, as per SRE 2400, uh, as per SRE 2400, had a reason to believe that a fraud has been conducted, okay, has been conducted, a fraud has been conducted, okay, on the company of rupees 25 crores. Mr. Manan, while performing the review of ABC Limited quarterly FS as per the SRE 2400 or under SRE 2400, had a reason to believe that a fraud has been conducted on the company of rupees 25 crores. Okay. Now, kindly guide Mr. Manan on relevant reporting requirement of such fraud. So where, like on which places Mr. Manan is required to report such frauds? So Mr. Manan, I'll just provide one more thing here. He is not auditor of company. Okay, I'll give you additional information. This review was being performed on instructions of DEF Limited, as DEF Limited was planning to invest in ABC Limited. Now, you tell me, Mr. Manan had a reason to believe, okay, that a fraud has been conducted. Fraud has been conducted of rupees 25 CR. Now you need to guide with the relevant reporting requirement. Okay. Where Mr. Manan is required to report this particular fraud. So suspected fraud identified during review, kind of. Suspected fraud identified during review engagement of rupees 25 crores. Now, what and where you will report this matter? As a reviewer, where you will report this matter? As a practitioner, where you will report the matter? Come on, guys. Where will you report this matter? Okay. So you are saying, very good, Mancha. So you will first report to those charged with governance and management. Okay, good. What else? Where else? Okay, those charged with governance and management. Then another answer is central government. Okay, central government, because it's greater than 1 CR. Okay, amount is greater than 1 CR. Okay, someone is saying NAFRA. I'm just writing down the answer. I'm not saying that it is correct or not. I'm just, writing down the answer as of now. Whatever answers you guys are giving to me. NFRA. Okay, fine. Where else? Come on, guys. Where else you will report this matter? Audit committee. So those type with governance is kind of audit committee. So slash audit committee. Because that will be those type with governance only. So audit committee will come here. Good, Suraj. What else? Very good, Charu. So central government and those charged with governance, yes, it's there. Then any other? Someone is saying SEBI. I will write it here, SEBI, along with NFRA. Because these are the enforcement entities. SEBI. Okay. What else? Anywhere else you will report this matter? Anywhere else, guys, where you will report this matter? Come on, very important area you missed out. Important area you missed out where you will include the matter. Okay. One is to auditor. Okay. What else? One more important area, guys, you have missed out. Where will you report the matter? Very good, Suraj. Your review report. Okay. Review report is the main where you will report the matter. Okay. Now, see, if you give this answer, no, then this is wrong. This is wrong. Now tell me why. I'll tell you. Central government, no need to report to central government. Why? No need to report to NFRA or SEBI. Why? No, Tanisha. Uh, I haven't received your answer. No, it is not. I think no. So, again, I'm saying central government and NFRA or SEBI are not the correct ones. Why? Can anyone tell me the reason for this? Very good, Tanisha. Absolutely correct. Reason because when I talk about this engagement, we are not the auditors, not statutory auditors. Okay. And section 143(12) is applicable to statutory auditors, or 143(14) is applicable to cost accountant and company secretaries. So this is applicable to stat auditor and this is applicable to cost accountant and company secretary, but not to a practitioner who is performing a review outside the company set, because this review is for the DEF Limited. Now, instead of NFRA or SEBI, I will report the matter to the DEF Limited. Reason because I have been appointed, or the report is for them. Either I will report to DEF Limited, or either I can also include in my review report. Both are fine. So when I communicate with dosha with governance or management, I may also add up over here DEF Limited in my communications, because DEF Limited is the intended user. Okay. Reason because why we will not report to the central government is, it is section 143 is applicable to state auditors. We are not the auditors when a limited review is being performed. As of now, the language says that uh, if an auditor of the company in the course of performance his duty as auditor has a reason to believe. Okay, but we are not the auditors. We are not performing any duty, or discharging our duty as an auditor. That's why it may not be applicable in the case. But section 143(12) will not be applicable. That is for sure. Any doubt? Any doubt, guys, till now? So, very good question. What if the management of those charges governance are involved in the fraud? In that case, we are not required to report to the management if they are involved or those charges governance or any person who is involved. Rather, evaluate to whom your reporting requirement comes from. Okay, or to whom your reporting requirement is. It may be to the kind of DEF Limited or in your review or to some other person or higher senior management or those charged with governance or some other person in the entity. In that case, you need to report to them. So you need to understand who is part of that fraud, and that person should not be reported or made aware of the fraud. Any doubt till now? That again depends upon the requirement, who is involved. You need to evaluate whether such reporting is required or not. What is the nature of fraud, who are involved, and a lot of things. On the basis of that, you can decide whether whether the reporting to the auditor is appropriate or not. In this case, if I say, this is the classic case of non-compliance with laws and regulations. Okay, no clerk. Now, if you identify non-compliance with laws and regulations, okay, then in that case, what is your responsibility? What is you are required to do in case of a listed entity? Again, we have a code of ethics for that. So you need to comply with the code of ethics. Any doubt till now? Any doubt with respect to this? Okay. If no doubt, then guys, we will keep till here. I'll request you to revise whatever we have, discussed today. Reason because in the next lecture, when I will continue and we'll cover the next SRE, at that point in time, again, these things which are repeated, these topics which are repeated from SRE 2400 to 2410, we will, just cover it in a summary form, and then we'll move to the parts which are critical and important to that particular SRE. Okay. So please make sure you revise whatever we have discussed today. And please, try to read well in advance, okay, of the SRE 2410 also. Clear? Yes, Manja. So yeah, although we are talking about limited insurance, but the procedures are not limited. Yes, absolutely correct. Okay. So Thank you guys. Thank you for participating in today's lecture. I'll see you in the next lecture. Yes.